Financial crises, dispelling myths to do with the latest financial crisis and highlighting ways to avoid them in the future. The Greek philosopher Socrates is widely credited as one of the wisest men of all time. His Socratic teaching method centered around questioning what you're told by others as well as yourself. The myth that we will dispel is that greedy bankers are the ones that should take sole responsibility for causing the latest financial crisis. The story of the greedy banker is well known, therefore we will focus on the layers of actors above and below the bankers, namely Alan Greenspan of the Federal Reserve and individual homeowners that were also responsible for turning a bad situation into a disastrous one with catastrophic results. We will introduce the concept of narrative and how the stories we tell each other every day can influence our decisions and how we interpret certain events. When considering investment options, we are normally pretty comfortable with a trade-off between risk and reward. We know that savings accounts offer low risk and reward, whereas stocks or equities represent high risk and reward. However, a study from two prominent economists, Case and Schiller in 2003, found that people viewed houses as a low-risk, high-reward investment, which is irrational. This graph shows us that we should expect real house prices to remain largely flat, as they have done for the past 125 years, and not increase at the rate that they were before the crisis hit in 2007. In the post-dot-com era of 2001, Alan Greenspan tried to kickstart the struggling US economy by lowering interest rates to record lows, introducing cheap credit into the market. It was upon this raft of cheap credit that inflation in the housing market was built. The low interest rates allowed current and potential homeowners to borrow too much money, much more than they could afford, therefore inflating prices. We have observed that the availability of cheap credit in the market, if left unchecked, will lead to an unnatural inflation in the house prices, right up to the point where the balloon bursts. The narrative that began to circulate between homeowners was that they could expect double-digit growth in the value of their homes. Studies tell us that individuals expected the value of their homes to increase threefold in under 10 years. Based on these assumptions, homeowners moved into bigger and bigger houses funded by cheap mortgages. They felt that their housing investment was safe and stable and that they didn't need to worry about what would happen if they lost their job, for example. These individual homeowners make up the base layer of the inflated housing market pyramid, built on the raft of cheap credit that was available in the market. Bankers, faced with increasing balances of mortgages on their books, became increasingly concerned that individuals had gone beyond the limit of what they could afford. The narrative they told themselves was that by packaging them up into bundles of mortgages, those that were low risk would outweigh those that were high risk, and through diversification, the issue would disappear. These mortgages originated not only from the US, but other places where cheap credit was available, such as Ireland, Spain and Dubai. The reselling of these packages took place to such an extent that all visibility of the quality of the individual mortgages was lost. These bankers form the middle layer of our inflated housing market pyramid, built on a base layer of mortgages from homeowners stretched beyond their means. The Case and Schiller report of 2003 was essentially warning Alan Greenspan that homeowners were behaving irrationally, that dangerous bubble conditions existed, and that the history of the 1980s was about to repeat itself. Greenspan, however, also fell victim to the power of his own narrative, telling himself and others that packaging of mortgages diversified the risk, and he could therefore afford to keep interest rates at record lows. Greenspan himself forms the top layer of our inflated housing market pyramid, perilously overlooking the dangers that lay beneath in the form of packaged mortgages. When, in 2006, there were job losses in the economy, this set off a series of events that would have disastrous consequences in every corner of the globe. Unable to keep up with the interest payments on their homes, individuals began defaulting on their mortgages, destroying the value of the inflated housing market, showing the value of diversification to be nothing but hot air. We've learned, therefore, that bankers weren't the only ones at fault in the financial crisis of 2007-2008. Alan Greenspan and individual homeowners were also at fault for falling victim to the power of their own narrative. The idea that packaging up mortgages diversifies the risk was shown not to be true. Worryingly, however, it seems that this lesson has not been learned, as we are already seeing packaged mortgages being sold again in 2015. Greenspan should have listened to the lessons of the past and realised that packaging up mortgages didn't make the market any different to the 1980s. Other countries with cheap credit, such as Canada and Brazil, should also be aware of the risks that come from the melting pot of cheap credit and an irrational narrative. The narrative of the individuals was that houses were safe investments made up of bricks and mortar and represented low-risk, high-return investments. We need to be aware, however, that this is a paradox. In order for us to avoid financial crises in the future, we need to acknowledge that we all have a part to play. The ability to question and think objectively gives everyone from homeowners to Alan Greenspan the Socratic wisdom to avoid making the same mistakes again. As the old saying goes, if it looks too good to be true, it probably is.